The work of academic luminaries such as Eugene Fama and Kenneth French shows us that small cap and value stocks have higher expected returns over time than growth style stocks. In the past few decades, however, an increasing number of leading academics have found convincing evidence that expected returns of equities can be improved by taking into account the so-called profitability factor. In other words, combining stocks with higher book-to-market ratios, a common measure of value, with those that have produced relatively higher levels of profitability is a powerful combination. One of the most highly cited and well-respected of these academic researchers, Dr. Sunil Wahal, has most graciously offered to join us today. Thank you, Sunil, for taking the time to discuss the portfolio interplay between profitability and value.
Thank you, Murray. It's a pleasure to be here.
Before we begin, I should mention that Dr. Wahal is the Jack D. First Professor of Finance and Director of the Center for Responsible Investing at the W.P. Carey School of Business at Arizona State University. His work has been published extensively in academic and professional journals, such as the Journal of Finance, the Journal of Financial Economics, and the Review of Financial Studies. Sunil is a consultant to asset manager Avantis Investors. Prior to that, he was a consultant to Dimensional Fund Advisors for more than 14 years. Sunil, much of your research digs into the impact of holding value stocks in a portfolio. In layman's terms, what does this mean for investors?
The idea of value stocks is actually as old as time, and it should be very intuitive to most people. I mean, the idea of value is basically the idea that you want to purchase something whose price is low relative to fundamentals. And, when I say fundamentals, I mean the benefits that one derives from holding that. Now, it doesn't even have to be a stock. It could be anything. Most consumers think about buying a pair of jeans or a jacket or a house or whatever consumer item it is. And you think about what benefits you can get and what the price is relative to those benefits. So the idea of value is simply the idea that on average, you want to pay less for those benefits, less for those assets than otherwise. And if you can do that, you reap some benefits from that in the future. That's value in a nutshell.
And that is, in a nutshell, the premium that investors can get from considering value.
Right. So when we formalize this in stock portfolios, for example, that is precisely the value premium. It's, you're purchasing assets that have low price relative to, we traditionally measure it using book value, and there are good economic reasons why we use book value. It has to do with the fact that a firm's profits flow through its accounting statements, through its income statement, to the balance sheet, and eventually to stockholders. And that's why we think of the book value of equity as sort of a measure of fundamental value, if you will.
Okay. Book value is the difference between liabilities and assets, correct?
Yeah, essentially, yes.
Okay. How would you explain it in more detailed terms?
Well, if you think about a firm that has, let's say, $100 in revenue, $60 in costs, and what's left over in some way, shape, or form after the sort of a variety of expenses and things, call it $20. Where does that $20 go? You can pay it out as dividends, or you can keep it inside the balance sheet of the firm for use thereafter. And if you do that, it flows through to the balance sheet, and it increases the book value of that balance sheet. It's what we call, in formal terms, sort of clean surplus accounting, because a dollar has to be accounted for. It has to go somewhere, right? Mm-hmm. And so that's how we account for it. And that's sort of why we generally, at least as academics, prefer to use book value in scaling price in terms of thinking about value.
You've also looked at the so-called profitability premium. Please explain how that works and what you use to measure profitability.
So profitability you can think of as the analog, or actually as Robert Novi Marx describes it as the flip side of value, the other side of the coin, if you will. So instead of thinking about prices being low relative to some fundamental value, think about the benefits that you get from purchasing either a stock or a pair of jeans or a jacket, and ask yourself, do you care about those benefits in addition to the price? And the answer is generally yes. So the profitability premium basically says, what benefits can you derive? Do you earn higher returns in the future for buying more profitable securities than low profitability securities? And the answer to that is yes, you do. And that, again, I think for most consumers, even everyday consumers, not even stock investors, that should make a ton of sense. It's sort of very intuitive, right? That that higher profitability securities should earn higher returns.
Sure. And in your research, you looked at how combining the value premium and this profitability premium compares to simply buying the whole market, correct?
Yeah, I've looked at how it compares to simply buying the whole market, or even you can think about it in terms of just simply buying value or simply buying profitability, or combining them in some sort of arbitrary fashion. So therein lies the rub, Murray. It's actually very interesting if you start to think about it. Value and profitability are inherently intertwined. So if I tell you, you want to go purchase a security, and that security has a low price relative to its fundamentals, you might ask yourself, the average consumer would ask themselves, well, why is the price low? For a reason. Am I buying, I love dogs, don't get me wrong, but am I buying a dog? Right? So you want to think carefully about, in formal terms, or actually in industry, sometimes they refer to it as the value trap. Why are you buying a cheap asset? Are you buying it because it's cheap for a reason, or are you buying it cheap because you're going to earn something from it in the future? And the answer is you get a mix of the two. And so that's where profitability and value come together. That in a perfect world, what you would want to buy is something that is cheap relative to fundamentals and that gives you very high profits in the future, right? That's what you would want. And so combining those two is a really, really powerful metric, because what it does is it helps you separate the wheat from the chaff, so to speak. Right? It helps you separate those dogs out, and you can hold on to things that make a lot more economic sense.
In your paper, looking at the profitability premium and investment premium, you used hand-collected data from 1940 up to 1963. I was just wondering, what is the significance of stopping at this period?
So there's actually significance in both stopping in 63 and starting in 1940. So stopping in 1963 is because the vast majority of academic studies, barring maybe 3 that I can think of, start in 1962, 63. And that's because the CRISP and CompuStat databases that we generally use to study these sort of phenomena start at that time. And so, as you can imagine, there's lots of incentive for people to go fishing, trying to find things when there isn't really anything to find in that data. So stopping in 1963 avoids all of those kinds of problems. So you might sort of say, well, why'd you start in 1940? Why didn't you go all the way further back, or as far as you could go? Well, the answer is really simple. It has to do with accounting rules and disclosures. I mean, the Accounting Standards Board had to kick in, the Securities and Exchange Commission had to be born, it had to impose accounting rules, and all of those really don't get formalized till about 1938, 1939 or so that we can actually get financial statements that we trust, that aren't sort of cooked, if you will. And that's why I start in 1940. So it's a nice sort of really pretty out of sample is what we call it, like a period that nobody studied. So you can get a very good idea of what truth is, unencumbered by other people's investigations.
Sure. You've also studied the impact of trying to capture stock momentum in a portfolio. Funds recommended by IFA use momentum as sort of a back-end check in the trading execution process. Would you be wary of funds that tried to capture the momentum factor on the front end too?
I would be tremendously wary of those sorts of products. And the reason I say that is, I've spent, I don't know, 20, 30 years studying both momentum and studying trading costs and how one optimizes trading and things of that nature. Momentum as a phenomena and to exploit it requires a ton of trading, portfolio turnovers that are in the hundreds of % per year. And so that amount of trading, no matter how you cut it, is going to dwindle away at returns. And basically, imagine yourself walking down the street and every 15 seconds, somebody picks your pocket and takes $1 out, $1 out, $1 out. Well, you walk 5 miles and a lot of dollars have disappeared, right? So it's one thing to say, well, I'm going to protect my pocket so that people don't pick the dollar. It's another to just leave it unprotected and just have it picked. That's the danger. Momentum has a ton of turnover in it and requires a lot of trading to exploit. And it's just going to sort of dwindle away at returns.
Sure, but it's worth checking, I guess.
For sure. I think from a defensive perspective, it makes a ton of sense to protect yourself from momentum. Trading it actively, on the other hand, is a different story altogether.
Okay. Finally, we've already touched on the fact that your work is supported by a rich body of evidence. Would it be possible for you to give us a brief overview of the history behind major discoveries in financial science?
Sure. So I've been talking about this to sort of investors all over the place. It's sort of interesting when somebody had asked me to give a talk on the history of financial science, and I learned things, frankly, Murray, that I didn't know, and things that I had forgotten. So, for example, this idea of present value and annuities. Now, if I asked you where that came from, most people, I didn't know, quite frankly. Believe it or not, the first written work on present values and annuities came from the famous mathematician Fibonacci of Fibonacci's sequences in the year 1202.
Interesting.
So that's how far back it goes. When you think about size, for example, most of us, at least in academia, think of Rolf Bonz's dissertation in 1981 at the University of Chicago as the progenitor of size. And yet there is work by Marshall Bloom at Wharton and his co-author Frank Husick in 1977 that talks about size and that documents it in a slightly different form, but it's there. If we think of value, we often think of Fama and French, and rightly so. But the first work, as they acknowledge, on the formal work on value dates back to a professor named Sanjoy Basu at McMaster University in Canada in 1977, well before anyone else. And there's others, there's Reingenham's work, there's Lakonishok, Schleifer, and Vishny, and frankly, the elegance and beauty and the genius of Fama and French is to take all of this historical evidence that existed prior to their work and bring it together in a cohesive fashion in the early 1990s. So all of this work has old, antecedents that go way back. So it's sort of very interesting to sort of think about the evolution of financial science. And it's not as episodic as you would think. It's not like, oh, suddenly there's a breakthrough. No. These things have been sort of inching forward in time, if you will. And then, it's not an aha moment. And so progression matters.
Sure. Well, thank you very much for your time, Sunil.
Thank you.